Hello and welcome to Insider Shot. So in this video, we'll briefly discuss about Bollinger Bands and how it is calculated. So let's start. So we'll start with the calculation of Bollinger Bands first. So here, as you can see, we have a collection of pipes. So suppose this is a collection of pipe which has an average height of say 50 centimeter. So each pipe is of a different height, but combined their average height is 50 centimeter, which may fall somewhere around this part. Okay, so suppose this line represents the average height of these all, or you can say a group of these pipes. But what's the disadvantage of taking the average height in this group is it doesn't represent all the pipes that are in this group. So according to statistics, what is done is standard deviation is taken. Standard deviation is taken which tries to cover all the samples in a group. So if anyone is a student of statistics, he or she may know how standard deviation is calculated. So suppose if the standard deviation of this group is 10 centimeter. So if we take one standard deviation above this and one standard deviation below this, okay, and we draw a line, a few more pipes in this group start getting represented by the data. Okay, so according to statistics, one standard deviation covers 68% of the data in the group. Two standard deviation covers 95% data in a group, and three standard deviation covers 99% data in a group. Okay, and so in this same data, if we go for another two standard deviation, which will be 20 centimeter, will be the two standard deviation, 2 times the standard deviation, more pipes in the group will start getting represented in that data. Okay, so this is simply a statistical method which is used in Bollinger Bands. So the same data calculation and same method is used in Bollinger Bands. So what is the formula of Bollinger Band? Bollinger Band uses 20-day moving average, simple moving average, which is nothing but the average of the previous 20 candles in whatever time frame you are using it, and it uses 2 standard deviation. So the common formula for Bollinger Band, if you use it in your browser or your trading terminal, is 20 and 2. 20 stands for the 20-day moving average and 2 is the standard deviation. So now we'll just see how this band is plotted. Okay, so right now we have this. So suppose this is the 20-day moving average or the 20-day average of the stock price. So for each point, a standard deviation is calculated. Again, standard deviation has a different calculation formula, which people who have studied statistics will know. It is derived from the mean, that is the average. So if we see this as a 20-day moving average on a chart, suppose this is a chart and this is a 20-day moving average plotted in it. So from each data point, suppose there are multiple candles here. So each data point, its standard deviation will be calculated with the previous 20 candles in Bollinger Bands. So what happens, the upper Bollinger Band is plotted at 2 standard deviation and the lower band is plotted at 2 standard deviation. So it will go according to the moving average, the 20-day moving average, which is plotted. The middle line in Bollinger Band in your terminal, which you see as an indicator, is nothing but 20-day moving average, simple moving average. So what is the importance of this 20-day moving average is that there is a general consensus that price always sticks to this 20-day moving average. on any time frame, if you go and see any stock or any index, what happens is that whenever price goes beyond 20-day moving average, after some point it will always come back to the moving average, and if it is going below the moving average, it after some time it will come back to the 20-day moving average before falling further or going back up again. So that is different, but there is a general consensus in trading and technical analysis that price most of the time reverses back to the 20-day moving average and always sticks to it. And this goes with all the stocks and indexes. So this is the main concept behind Bollinger Band, is that since the 2 standard deviation always covers 95% of the data. So in this case, in stocks, 95% of the price will be covered of the previous 20 candles, as 20-day moving average is being used. And this 95% certainty is used in most of the research work and hypothesis testing as well. So this is the most standard input or category to use. So this is the simple theory behind Bollinger Band, is that price always sticks to the 20-day moving average, and the 2 standard deviation will always cover 95% of the price. So if the price is near the second or below the upper band or the below band, so most of the time prices does come back to the 20-day moving average, which many people use in combination of different indicators to trade in the market. Okay, so this is just a simple explanation of Bollinger Bands. And if you like this video, do subscribe to our channel. We'll be coming out with other videos for other technical indicators as well. Thank you.